Hello, I'm Peter Jones and Chairman of Century Global's Advisory Committee. Today, I'd like to talk to you about our most advanced I know project, which is the Joyce DSO project. While Century owns some of the most extensive I know resources in Canada, its most advanced project is the Joyce DSO project, and this is located in Newfoundland and Labrador, just over the border from Quebec and about 20 kilometers from the town of Shefferville, which has an airport and other facilities and is the northern extent of the Shefferville to Sept-Îles Iron Ore Railroad. Joyce is located in the Labrador Trough, which is a well-known region of Canada that has produced iron ore in very large quantities for in excess of 60 years. We're excited about Joyce. It's an advanced project. It had feasibility completed back in 2015, and environmental impact statement was also completed. We're in process of updating and optimizing both of those documents and applying for permitting. That is ongoing and a high priority for us. Recently, we've seen a significant upswing in the price of iron ore, and that holds great promise for this project. The project has good returns at relatively modest long-term pricing and very extraordinary financial returns at higher pricing. We believe, after quite a considerable amount of analysis, that this upswing in iron ore pricing is likely going to be with us for some 5 years. We have an opportunity to participate in that upswing. So let's take a look at the presentation, and I'll just share some screen information with you. So I'll just move my face out the way there so you can see the numbers. Before we get into Joyce Lake proper, let's take a look at the iron ore price, and I draw your attention to the darker blue line, and if you look at the 2011-2012 period, this is towards the end of the last metals price super cycle, and you can see iron ore hit around about $190 per ton, delivered China, US dollars, of course. Then it went into a protracted period of decline, hitting a low in the 2015-16 period of sub $40 million. It stayed relatively low for a number of years after that, but in 2020 broke out substantially and was the highest metal price gainer on a global basis. In 2021, January 21, the average price available CFR China for 62% iron ore, which is the world standard, was 167.83 US per ton, which is a very encouraging indeed. Well, why did the price fluctuate like this? We've done quite a bit of analysis, and our belief is supported by the fact that there were a number of very large iron ore mines that came on stream, principally in Australia and in Brazil, up to 2016, 2017, and they pushed the price down quite dramatically. The demand from the principal consumer of iron ore, which is China, for the most part, was maintained and increased. And in recent years, we've seen a steady increase in demand from China. Those new mines are now fully complete. There are no new commitments for large new mines that will contribute to the seaborne market. And as such, I think it's fair to say that the mines supplying the seaborne market are basically capped, while China demand is slowly but steadily increasing. So we have a situation, supply capped, demand continuing to increase, and that is affecting pricing. And because it takes 5+ years for a major mine to come to production, we believe this supply-demand situation will persist, and we'll have buoyant pricing for the next 5 years. So let's move now to look at Joyce Lake proper. And I'll work from the results back to some of the more basic information on Joyce. So you can see on the left-hand side of this chart some basic parameters. And the production rate from Joyce open pit is expected to be 2.5 million tons per year from its reserve of 17.7 million tons. The capital cost is projected to be 259.6 million Canadian dollars, and the price to produce a ton of iron ore, to get it into a boat, what's called free on board, in the port of Sept-Îles, which is in Quebec, is expected to cost $58.25 per ton Canadian. The construction time for this project is short, 1.5 years, and the life of mine, the time from the completion of construction through to depletion of the reserve, is some 7 years. The first 5 years would be at close to 62%, which is the world iron ore content standard, and the last couple of years would be at a lower grade, basically recovering stockpiles, etc. If we move to the bottom of this chart, you can see the pre-tax net present value. Based on the feasibility study back in 2015, we used a long-term price of $95. That's selling price CFR China, which generated an NPV of $130 million Canadian. If we inject the 167.83 per ton that was obtained in January, just a few weeks ago, of 2021, for the entire life of mine, we see that the pre-tax NPV jumps to some 1.3 billion Canadian dollars, a very large number indeed. Now, we're not suggesting that we'll necessarily get 167.83 for the life of mine, but we are suggesting that the buoyancy of the iron ore market price is quite considerable going forward, and we see that buoyancy persisting for 5 or more years. Where is Joyce? Well, if you look on the left-hand part of this illustration, you can see the 5 deposits that Century controls, including Joyce Lake, which is 100% held. And in the center, you can see the location of Joyce, the top. We contemplate a 43-kilometer new haul road, which would be a simple dirt road connecting to an existing heavy-duty iron ore haulage railroad, which runs from Schefferville all the way down to Sept-Îles, a distance of 565 kilometers. The ore would be trucked to that railhead, loaded on iron ore trains, and delivered either to the IOC port or the multi-user port in the Sept-Îles area. All of this, of course, is in the Labrador Trough, which is why this railroad is here. It's been here for many, many years. A quick look at the Joyce Lake feasibility study reserves. And these were established after some 20,000 meters of drilling, and they've brought the deposit to a high level of confidence. I draw your attention to the bottom line of the table, and particularly the highlighted 17.72 million ton number. Immediately above that, you can see that the proven and probable at plus 55% iron cutoff generates about 14 million tons of 61.38, which is very close to the 62% world standard. And then the 3.6 million tons at lower grade would be part of the material that would be mined in the last 2 years of the 7-year life of mine. I think this graphic is quite interesting. It shows the key activities all the way from mining through to delivery of the Joyce Lake products to, in this case, our base case, which is China. So starting in the top left, the open pit would be a conventional drill and blast open pit. We're loading to conventional open pit trucks of the 75 to 100 ton capacity. There will be a short haul of a couple of kilometers to a crushing plant installed at site, which would create sinter fines and lump ore in the ratio of about 35% reporting to lump and 65% reporting to fines. It's interesting to note and important to note that there would be no tailings, no liquid effluents. All of the mined ore would be crushed and segmented into sinter fines and lump ore, and it's a completely dry process. Those sinter fines and lump would then be truck hauled some 43 kilometers to the railroad, loaded on 100-ton iron ore cars, and railed to one of the 2 ports in Sept-Îles, where it would be loaded onto Capesize or larger vessels, and in our base case, shipped to China. It's possible we might send it elsewhere, but our base case is to China. Also in this graphic, you can see blue banners that show the costs, the operating costs for each of these activities. And the darker blue banners at the top, for example, combine mining, crushing, and general administrative cost, operating cost, which we call OPEX, which shows $21. The banner at the far bottom of the graphic shows the land portion, transportation portion of this cost to be $37.23. That's basically the trucking cost, the railing cost, the port cost, and the loading of the boat. And in the bottom right, you can see the total cost, total operating cost to get it from in the ground to onboard ship, which is $58.25 Canadian per ton. To get it to China costs more, and that is shown in the bottom left. And the cost to do that would be some $15 US per wet metric ton. So please keep those key dollar values in mind as we go through the rest of the presentation. But first, let's look at the ports. We got a choice of 2 ports. One is the IOC port on top here at a 30 million ton per annum capacity, and also the new multi-user port, which has got some 50 million ton capacity. Both these ports are year-round ports, deep water iron ore ports. Moving on now to a little more granularity regarding costs. And we're dealing here with both capital and operating costs, which we call CapEx and OpEx. On the left-hand side of this chart, you can see the CapEx expenditure breakdown. I won't go into that, except I'll draw your attention to the capital cost at the bottom in red. You've seen that number before, which is $259.6 million Canadian. That's to get this project into full production. On the right-hand side, the operating costs, again, broken down by activity, but again, let's look at the red banner 3/4 of the way down, which shows the cost to get it out of the ground and all the way onto board ship in Sept-Îles, which is Canadian $58.25 per ton. Now, for convenience, we frequently convert these to US dollars because our products, just like every other mining product, is sold in US dollars. So if we convert these numbers, you can see that the capital cost converts in US dollars to 207.7 million US dollars. And the operating cost converts to $46.60 per ton. Now, a new number, we call it CapEx per ton. That is actually what we call capital intensity, which is fundamentally the capital cost divided by the product volume to give an indication of how much per ton produced the capital impact is. And in this case, in US dollars, it's $11.72. So here we can, and I'll just move my picture out of the way so you can see the triangle. This is a reflection of the margins per ton that are available over the first 5 years of production. That's when we produce close to 62% INO, world standard. What sort of margins per ton are available? So it's somewhat difficult to follow, but let me guide you a little here. If you look at the 4 columns on the far left, which includes the cost FOB on board a ship in Seattle, which is $46.60 US. The sea freight to China is $15.96 per dry metric ton US. A small adjustment for premiums and penalties on the type of ore we sell is 33 cents. The capital intensity that we talked about a minute ago is $11.72. Now, if we add those 4 together and take it away from the 7th column from the left in deep maroon, which is the $95 that we used in 2015 for the feasibility study selling price over the life of mine, we get a margin of $20.39 US per ton. If we in turn take out the capital intensity value of 1172, that margin on a pure operating cost basis, because the capex is obviously sunk, we get a cash margin of $32.11. So we make $32.11 on every ton sold if we sell it at $95 US per ton. So what happens if we sell it at, or if we sold it in January of this year at 167.83? Well, if you do the same calculation, except substitute the $95 for 167.83, you'll find that the margin is in excess of $100 US dollars per ton. Quite an extraordinary increase, but a reflection of some of the opportunity that is available on this project. We can get adequate returns at 95 and extraordinary returns at higher pricing. We're not necessarily suggesting that we're going to get 167.83 for the entire life of mine, but it's quite possible that we will get periods, and we believe extended periods of higher pricing than $95 a ton. Let's look at the schedule. I'll move my picture out of the way again. This is a schedule of some of the key activities through from now to full production from the project. I won't go into the details except to say we are actively optimizing the feasibility study. We are similarly examining the environmental impact statement and expect to be able to submit that to regulators within 6 weeks from now. And we're expecting to receive environmental permit to proceed within 12 months from now. There are a number of other activities that have to take place, which are quite normal for a project of this nature. But the important point to make is we're expecting 12 months from now to be in a condition that we call shovel ready. In other words, all the permits are in place, all the technical aspects are complete, and we can make a production decision and attract investment for that production decision. There would then be a construction period of 1.5 years. And if you add, of course, the 12 months from now to get to shovel ready and the 1.5 years of construction, in 2.5 years from today, we expect to be in full production. So let me just summarize the presentation and some of the key points. We've got a simple open pit DSO project. It's blessed with existing major transportation infrastructure, primarily rail line close by, and 2 major iron ore ports in Setil. It's well defined with a feasibility study already done and $40 million invested to date in drilling and studies and test work, and the list is very long. We are optimizing the existing feasibility, and we are updating the EIS and applying for permitting on a priority basis. It's a project that's quick to production. 12 months to shovel ready, and another 1.5 years to full production. We're experiencing a strong market right now, and our analysis suggests that that market upcycle will be with us for 4 to 5 years as we look forward. In addition to that, there may be a strategy of hedging that can be employed on this project. Certainly not committed at this stage, but it is a possibility to further enhance the financial returns. We have a good project at $95 selling price over the life of mine. And as you saw from some of the NPV projections, at higher pricing, it can provide extraordinary returns on investment. And in addition to that, we believe that there are opportunities to reduce the capital cost that was projected in the feasibility study. And we are currently actively pursuing ways to reduce both the capital and the operating costs, which will further improve returns on this project. And finally, Century has previously issued news releases about the fact that it is planning to spin out Joyce Lake. I encourage you to keep that on your calendar as it represents an opportunity for direct investment in Joyce Lake in this well-advanced project. Thank you for being here today and listening to my presentation. Very pleased to answer any questions you may have. And Sandy Chim, President and CEO, similarly is available at any time to answer questions or provide clarifications. So thank you again for your attention.